Right, good afternoon, ladies and gentlemen. My name is Michalis. I'm the market analyst here at HF Markets, and I'd like to welcome everybody to the first webinar of this week. And it's the first webinar as part of my personal webinar series that we're going to be looking and discussing as part of the whole webinar. We're not looking at different aspects of the market, but we're concentrating specifically on one view of the market, on one trading methodology. And it's the first webinar where we're actually going to be looking at step by step how we can use this strategy as part of the scalping overall methodology in that specific category of trading. We've had a lot of great feedback from the webinar we did last month where we were looking at trading the trend and a specific strategy and quite a simple strategy as well at looking at how to determine the trend, and not only how to determine the trend, but the specific window which traders have in order to be able to take advantage potentially of that price movement. So today though, we're going to be looking at a specific methodology which is known as scalping. Now, if somebody doesn't know what a scalper is or scalping, it does sound slightly aggressive in terms of the name of this methodology, but I promise you it's nothing of the sort, and it's purely related to trading and a very professional way of looking at the market. Today we're looking at a simple strategy. I say a simple strategy, it doesn't mean it's less effective, it doesn't mean it's something that more experienced traders don't use, but I'm using the word simple because the way I have constructed this strategy and the way we have put it together, it is even something that anybody that has been trading 1 month or 2 months, or somebody who has never even traded before can potentially, if they wish to, apply to their own investments and trading. So today we're going to be looking at scalping more specifically, and of course the most important thing is that we're also going to be looking at a strategy where we're together going to be looking at step by step how we can use this specific strategy, which is of course, like I said, part of that scalping methodology. But of course, the very first few slides, what we're going to do is get an understanding of what scalping is and what is important as part of the scalping trading plan. And then on the following webinars, we will dive into step by step how you can use this strategy, which is very advanced in some aspects, but in terms of learning it, it's very simple and something that even somebody who has never traded before can take advantage of, which is the great thing about this strategy. Before though we start looking at this, very quickly, I want everybody to be fully aware that of course here at HF Markets, we are dealing with investments, and as with all investments, there is of course a risk to the capital that you are investing. Doesn't matter what type of investment it is. If you're looking at stocks, cryptocurrencies, if you're looking at for example CFDs, derivatives, whatever it may be, we are dealing with investments. As with all investments, the investment of course depends, the performance of the investment of course depends on the price movement, which we have no control over. But what we of course do want to do, even though we're not giving investment advice in any way, shape or form, we want to provide as much educational material in order for you to be able to trade with confidence, with knowledge, with expertise. And of course, this is again why today's webinar is so important, because yes, it's important to have risk management, trading plans, and at the same time how to analyze the market, but something which is also equally as important, like we're going to be looking at today, is an actual strategy, a step-by-step strategy on how to determine when is a potential entry point and when is a potential exit point. Because we have a lot of individuals who say to me, you know, I believe there's going to be a trend over the next month. which, okay, yes, it's a certain percentage of the work is done if you're successfully able to determine the trend over the next month. But as a trader, it's not good enough. We need to be able to determine how to benefit from a specific price movement. So yes, it may be looking at an upward trend over the next month, but during that month, the price is going up and down again and again and again. So our entry and our exit is still extremely important, which is why strategies like what we're going to be looking at today is vital to traders and investors. Now, I don't want to spend too much time as part of this slide. I'm going to go through it super quick. The only reason I've got it here because a lot of people do message and ask some questions. Here at HF Markets, I'm the market analyst. I originally was a financial advisor actually for 4 years in London. I've been a market analyst for 5 years. I've been investing for almost 10 years now. Here at my webinar, in my webinar series, what I want is, of course, to be looking at simple learning methods, a way of taking more advanced strategies which more professional, experienced individuals use, and looking at it in a more simple way, so everybody is able to take advantage of this. This is what we're, of course, concentrating on. And again, I don't want to spend too much time as part of that slide, so let's move on. Ladies and gentlemen, by the way, I can see quite a few people have put their hands up. I don't know if you have a question. Since I've seen people are putting their hands up, I think this is a good opportunity to tell everybody that they do have the ability through the GoToWebinar software to ask questions. You can ask as many questions as you like. The benefit of one of our on-site seminars, our online webinars like this as well, is that you have the ability to ask as many questions as you like. We even have individuals, for example, in the last webinar, where they gave a specific scenario which they experienced and would ask some questions on it. So there's a benefit for everybody if you are asking questions, of course. So don't feel shy about asking questions. We will not, of course, expose any sensitive information such as your name and region. We will very simply read the question, answer it, and move on. So before we, so now that we're actually going to start to dive in slowly, looking at scalpers and scalping, what I want to mention, the first thing is that when we're trading, people think that trading is a specific category under investing, because there's a lot of different types of investments. One method of investing is, of course, that branch, which is known as trading. But still under trading, there is different ways individuals can trade. For example, we have a strategy known as an intraday methodology. We have session traders. We have also swing traders. We have also position traders, which is a very long-term strategy, less popular, something that we don't see as much with CFDs, but we can potentially on other types of derivatives and generally in the financial trading markets. But today we're looking at something which is extremely popular for CFDs, and it's designed to specifically take advantage of the characteristics of CFDs, which is why there's a lot of requests, a lot of demands for educational material on scalping. If anybody's researching on Google and on YouTube, there's so much questions, so many videos about scalping. But people have to be careful because there's a lot of educators which have never been successful. They may be showing fancy cars, they may be having a nice desk, a much nicer desk than mine, for example, but what they are providing is not something which is accurate, which is why, again, these webinars here are extremely important. So you need to be slightly cautious if you're doing your own research. So let's start looking at scalping. Now, CFDs, their specific characteristics to CFDs. Why? Because CFDs, they use leverage. Because they use leverage, and in addition to this, CFDs have overnight fees, they are specifically designed and tend to be, especially if you go to a financial advisor and ask for their advice, they tend to say that because they have overnight fees, because they use leverage, because the financial trading markets are also additionally volatile as well, because of this, CFDs, they are mainly designed and appropriate for short-term trading, which isn't a bad thing. It's a good thing, of course. And it's specifically good for individuals looking to use the scalping methodology. So what is scalping? First things first, scalping is an ultra short-term method of trading. It doesn't mean you're going to invest your money into a trading account and in 5 minutes withdraw and become a millionaire. What it means is that it's ultra short in terms of each trade. So not the investment overall. The investment can be as short and as long as you personally wish. But what it means is that you're consistently and continuously active, opening and closing trades, but in a very short period of time. So this brings us to our first bullet point. This is what scalping is. It is opening small trades. It is keeping those trades open for a very short period of time. And it is looking for quick, small profits. Now, it doesn't mean you're earning less than anybody else which is trading using different methodologies. You could potentially actually be earning more. Some of the most successful scalpers in the world, the most successful that is, are looking at significant amounts of profits. So people shouldn't think because you're opening smaller trades, because you're keeping the trades open for longer, and you're looking to make quick, small profits, that you're earning less. It's completely incorrect. Very simply because yes, you're opening smaller trades, but you're opening more of them. And there's a lot of advantages to scalpers as well, especially with beginner traders, because the very important thing about beginner traders is they don't want their investment to be moving, especially in the very few first days, first weeks, to be moving extremely, extremely quickly. Very simply because they're beginners, they're learning, they want to learn, they want to build their account, and slowly, slowly they can, of course, look at increasing their take profit, increasing their trade, and so on and so forth. So there's a lot of benefits, especially for beginner traders, when looking at scalping. Now, what is required for a scalper? You have to remember, scalpers, they're looking to enter, and sometimes in a couple of seconds. It could be a couple of seconds, it could be a couple of minutes, it could be, for example, 20 minutes, it could be 1 minute alone. But what they're looking to do is they're only in the market very quick. And the benefit of this as well is that you're limiting the risk as well to the market and volatility. But what it requires is very cheap spread. So if you're going to go to an extremely exotic pair which has a very wide spread, or another asset, cryptocurrencies, for example, again, it may have a very wide spread, it's going to be very difficult to be a scalper. So when you're scalping, you're only limited to those assets which offer a competitive spread. Most likely the cheapest spread. Now, some people may say to me, I don't want to trade the Euro USD, which has the lowest spread. I want to trade the US dollar against the Turkish lira, which has a very wide spread. You know, it's completely down to you how to trade them, when to trade them, what to trade. I've got an individual here who's saying he cannot hear. If anybody else cannot hear for whatever reason, if you can mention it on the question section, and I can make sure that everything is working appropriately. But I'm guessing since nobody else has mentioned it, everybody can hear. Okay, everybody's saying it's clear, great. So what was I saying? If you're looking to trade something which is more expensive, it's just going to make your life more difficult. So if you're going to look to be a scalper, limit yourself, and you'll find the same information wherever you're looking, to the assets which have the smallest fee. And very simply, this is in the market referred to as a spread, which is the difference between the bid and the ask. As soon as you open the trade, you'll see you automatically straight away go into a minus. That is very simply the spread. It is the fee. It doesn't mean you can only trade the Euro USD. You may be looking to trade indices, but if you're going to trade indices, trade the cheapest one. Overnight fees, I've got an individual who says, is it also important to be trading an asset with the lowest overnight fees? No, it's not, because you're looking at a very ultra short trading methodology. So you're never going to be having trades open overnight. Now, point number 3, scalpers need to stick to their plan strictly stick to their plan, and I'll just add here, stick to the exit point very strictly, because one large loss can wipe away profits from multiple trades. So if you're keeping to your strategy strictly, and you may be earning 0.3% on one trade, next trade 0.3%, the next trade 0.3, and you're doing that for 20 successive trades, but then you make an incorrect trade and you keep the trade open, you keep the trade open, you keep the trade open, and you're losing 0.50%, you've just wiped everything that you have earned over 20 different trades. So you have to be very strict, and it's not so forgiving when you're looking at scalping, because you're looking at an ultra short period of time and you're looking at quick earnings. So you have to keep that into consideration. Your exit must be also super strict. Now let's compare an intraday trader and a scalper. An intraday trader, somebody who's looking to trade and close a trade within the same day. This is just an example. I just want for people to be able to see the difference between the two. An intraday trader may be opening a trade of 0.10 lots. He may be doing so twice a day. This is just an example, maybe more, maybe less, but it's going to be around that type of range. Whereas a scalper is going to be opening a much smaller trade size. Instead of opening 0.10%, and again, this is why I say it's sometimes a great method for beginner traders, because very low levels of exposure. Instead of opening at 0.10 lots, he opens 0.01, the very lowest lot which is available. And instead of opening 2 trades a day, he opens 10 trades a day. It may not be every day, depends on your daily life and your time sensitivity and so on and so forth. But again, this is just an example, and you can see the difference there. What are the examples of assets with low and cheap spreads? The best thing for you to do, ladies and gentlemen, is go onto our website. We have a list of all of these. If you need some assistance, go to live chat. Our support team is always available. Message them, tell them, can I please have a list of all the assets and the minimum spread as well, and I'll provide that for you. Off the top of my head though, it's most of the time tends to be the Euro USD, of course, which is going to be the lowest most likely, and also the USA 100, also known as the NASDAQ. When scalping, it is important to determine the direction. It's not important to determine the direction of the asset. It is important to determine the direction of the assets in a specific period of time. If somebody comes to me and I'm a scalper and he says to me, I know 100% that in this month, the US dollar is going to increase in value, I will say to him, that's useless information to me, because I'm going to open a trade and close it in 10 minutes. So there's a difference between the two. This is very important. There's a difference between being able to determine how the market is going to move in a medium to long term, and it's much more important to be able to determine how the price is going to move in a specific period of time. And this is very important. We're going to be looking at this at the end of the webinar. A scalper's code. Quite kind of quirky, kind of funny. I thought it was interesting as well, definitely to add this. So a scalper's code. Smaller moves are more frequent. So if somebody is looking for big moves, he needs to sit and needs to wait for big moves. It may not come tomorrow, it may not come the next day, it may not come the day after. Smaller moves though are always available. Another thing, smaller moves are easier to achieve. If you're trying to benefit from a long price movement, because they're less frequent and you need more discipline to be able to stay in the market for a longer period of time, it is more difficult to achieve. Whereas if you're entering, you're earning a profit, $1, $2, $3, closing the trade, it's a much easier way of looking at the market. Doesn't mean scalping is easy. We're not saying trading is easy. It definitely isn't easy, but we're saying as a methodology and as an approach. So from your experience, what are the best pairs for scalping? Euro USD, and also very popular. We've got a lot of educators online if you do your own research as well. And I say Euro USD because it has very low spreads, only for this reason, which is super important for scalpers. Another asset is the British pound against Japanese yen, which traditionally has very low spreads as well. But again, a lot of educators online, a lot of professional traders as well, tend to go down the route of the British pound against Japanese yen. Doesn't mean you need to do the same. The reason is because it has a lot of volatility compared to the amount of spread which is being charged. But of course, it's not advice. It's very simply pointing out the obvious to individuals. How you're trading and what you're trading is completely down to you. You have full control over what path you're personally going to trade. So a trader's plan. First things first, what asset are you going to trade and in which session? The tighter spreads are the most appropriate. I spoke to an individual the other day who's very popular on our platform, been trading a very long time, and he has up and down results. He has a week which is very successful, the next week is not so successful. The issue that a lot of beginner traders have is that they don't have a specific asset that they're going to trade. So they look at the market, they look at one asset, they look at the other asset, they look at another asset, and they try and find opportunity. Today, I may trade the US dollar. Tomorrow, I may trade the pound. The next day, I may trade gold. The day after that, I may trade crude oil. And I bet a lot of people who are watching today's webinar, if they look at their trading experience on the MT5 and then look at their past trades, they'll see many different assets, 5 assets, 10, 20, 30. There's a big disadvantage to this, especially when you're looking to trade with something which requires a lot of accuracy, like scalping. Each asset is different. If you're trading a different asset every single day, it's like you're starting from the beginning every single day. And your mind and your analysis is not going to be able to keep up with the market because each asset has different characteristics, different volatility levels, different leverages. What is influencing that asset and the domino effect is going to be completely different as well. So there is benefits to trading one asset. We're not building a portfolio, ladies and gentlemen. If people are watching YouTube and they're saying, mitigate your risk, spread your risk, trade as many assets as you like, it's wrong because that's about building a portfolio. When you're trading, you're opening and closing a trade continuously. So there's no spread in the risk in any way, shape or form in terms of investing in as many different assets as possible. There's advantages to trading one asset alone. Doesn't mean you trade less, doesn't mean you earn less. What it means though is that between now and in 6 months time and in 6 years time, if you're only trading that asset, your knowledge and your experience will be much vaster, more advanced, and you'll have more knowledge and experience because you are only trading that asset. The next thing that I will say, and I'm going to give you an example of this on the next slide, is that try and also stick, we've said try and stick to one asset, completely up to you what asset that is. The next thing is try and stick to one session because each session acts differently. So for example, a very well-known characteristic of the US session is that people tend to ignore price movements in the first 30 minutes because it tends to be, there's a lot of occasions where a price movement will form and then completely change. And then they also avoid the last 1.5 hours. Why? Because there's very little orders in the market, volatility, and again, the price movement there is at high risk because we come towards the end of the session. A lot of people don't want weekend risk, overnight risk. We've got a lot of scalpers, day traders that will look to close the trade as well. So this is, for example, something which is well known in the market from experience, generally speaking, not my experience, but generally speaking. But of course, you as an individual, if you're sticking to one session, you'll be able to pick these up as well. Stop loss and take profits need to be closer. If you're looking at longer term strategies, and medium term, and even day trading and swing trading, which are also short term, scalping is slightly different. Your take profit and your stop loss is much closer. You can still, if you wish, have a negative reward to risk ratio if that's going to help your success rate and your profit and loss at the end of each month. But again, it needs to be closer. So keep in mind, in a couple of slides where we start looking at strategies, because we're going to be looking at strategies in a moment. Hopefully today's webinar, everything will be done in an hour or an hour and 10 minutes. You will notice that we're opening more trades, smaller sizes. I'm not going to be open trades live, but we're going to be showing you the trades from the past few days. More trades, more often, smaller trade sizes and exposure, and also much closer take profits and stop losses. Very important. Another thing, very important, I can see a couple of questions. Let me finish this slide and I'll make sure we answer these questions. If you're, for example, looking to trade the NASDAQ, we spoke about the NASDAQ in today's market analysis. We said that, for example, that we saw a lot of strong profits yesterday, a lot of movement. We saw a lot of people enter very quickly. All these people are earning a lot of profit. When that happens, a lot of people tend to cash out. So we said there's a strong possibility of a retracement to the previous trend line, something that has happened. Keep in mind that was written and posted this morning. So I'm not saying it now that the price movement has happened. It was said before it happened. So before you start trading, if you're trading the NASDAQ and trading in the US session, before the US session opens, look at the day's bias. Look at what is influencing the asset. So let's look at an example. Say again, we're going to follow the NASDAQ. I know what tends to influence the NASDAQ. Everybody does in the financial trading market. So for example, the US dollar, strongly correlated with the NASDAQ. So when the US dollar is expensive and increasing in value, even today, if the US dollar is up, I know there's a possibility, it's not guaranteed, it's a possibility that the NASDAQ is going to be pressured. Next, it's components. Within the NASDAQ, there is 100 stocks. Some of those stocks are more influential than other stocks. So I'll look at the most influential. Some traders look at the top 20 most influential. Some people look at the top 10 most influential. So for example here, if we're looking at the US dollar increase in value, and I've got here the current performance of the most influential stocks, this is the top 10, I can see that 1, 2, 3, 4, 5, 6, 7, 8. 8, ladies and gentlemen, are in the red. So 8 of the top 10 most influential are declining, which is of course something which is going to affect the overall price significantly of the NASDAQ. Whereas if we look at the lowest 10 most influential stocks declining, it's going to have a minimal effect. These are the top most influential. So for example, Apple, Microsoft, Amazon, Meta, Nvidia, Tesla, etc. So again, I've got another bias here. 80% of the top, 70% of the top influential stocks are declining at the moment. Then I look at bond yields. Bond yields, when bond yields are increasing, today's another example where bond yields are increasing. We mentioned this morning in this morning's analysis as well. It's currently up almost 50 basis points, so a significant increase, ladies and gentlemen. When bond yields are increasing, stocks tend to decline. So this is just an example. This is building a bias before the market actually takes place. Before we start trading, before the US session opens and I'm starting to trade and open different trades, I build a bias. What is potentially likely to happen today? And ideally, I don't want these to be conflicting. I don't want my strategy to be saying buy, 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 but my bias is saying sell, sell, sell. Because when that is taking place, we're looking at higher risk trades. Whereas ideally, we want to marry the two. We want the two to be moving side by side. So for example, here we're looking at a more expensive dollar today, higher bond yields today, and all the components are decreasing in value or a large percentage. For example, yesterday, a large percentage was increasing in value. 93% of the whole of the NASDAQ increased in value. Let's say today is decreasing in value. So that is a bias that today the NASDAQ is going to decline because the dollar is more expensive, bond yields are increasing, and the components are decreasing. So there is a very clear bias there. So I'm keeping this in mind while I'm trading. So trades are known to bear a lower risk when indications such as these are not conflicting, but we can of course also keep this in mind and refer this also to technical analysis. So let me quickly answer the questions before we move on to the next slide. So will you mention about strategies applied for scalping like martingale? We're not going to be looking at the martingale strategy today. What I will say about martingale is that it's known to be, generally it's got a reputation of when it works, to work amazingly, but when it doesn't work, to be the most risky strategy that exists out there. Because what you actually end up doing is you end up trading against the trend, and you're increasing your exposure, which when you're doing that with leverage and while the trend is moving against you, unless it's going to imminently going to move back into your favor, it's very disadvantageous. So that's why we're not looking at it today. What you can look at, a different strategy, we're not looking at it today, is not necessarily associated with scalping, but what you can look at is, instead of martingale strategy, to be looking potentially something for you to research, scaling in and scaling out, which is similar but not so risky. So another question, great question. When you mention that you should allow room for some volatility, how does one determine the average volatility? Point number one, we spoke about this a lot of this in December. Always should be doing this whether you're looking at scalping or any other strategy. You should be measuring every single wave. So each time there's a wave and it begins and ends, measure it, make a note of it. Next wave, do the same. And then you should look at what the highest wave was, what the lowest wave was, and also from the past 50 waves, what's the average? And that's going to help you there. But today, we're also going to be looking at technical analysis to help to determine what is the appropriate level of volatility that we're going to allow. Is the influence determined by the asset weighting in the index? Yes, because we're looking at the stock market. These are the components. We, of course, are going to be looking at what is going to be affecting those. Also, if you're referring to the assets which have the highest weight, yes, that is the most important, of course, because that has the most effect over the price. Does the NASDAQ typically lag the components price movement? Not necessarily. No, it doesn't. Unless you're referring to after hours, in which case, yes, of course, when you're looking at after hours, the market is closed. Other than that, though, no, it is mimicking the price movement and follows and tracks that. So could you please revisit the 10-year bond yields and how it correlates with the NASDAQ? Yes, of course. Bond yields are very important for all stocks. So why are bond yields very important? Bond yields are important for stocks for two reasons. Number one, And I'll show you also at the end of the webinar how you can get access to this. This I've just, by the way, both these here, I've taken from Google. I've not used my platform or something that I have access to. I've used something that you can access, which is free and just as good. So I'll show you how to access these at the end of the webinar. Bond yields affect the market in two ways. Number one, when bond yields are up, what does it mean? It means that people that invest in US bonds, they earn more. Instead of earning, for example, 3%, they're now earning 4%. So what does this mean? This means everybody around the world is more interested in US bonds. So me and you and general people and institutions and professional traders, they start to pump their money in US bonds. So what does this mean? This means we need dollars. So we actually convert into dollars to buy US bonds. Doesn't mean that you'll go to one shop, convert, and then go to buy bonds. It happens automatically. So what happens is the dollar tends to increase in value. Not always, but it tends to potentially increase in value after high yields. So this is point number one, which is negative for stocks because it makes stocks more expensive. Point number two, when bond yields are increasing, what it actually means is they're more competitive than stocks. So if I'm sitting there saying, I could invest in bonds, which is super safe, so one of the safe haven assets, for example, and I can earn 4%, or I can invest in stocks and, for example, potentially earn 8%. It's not worth it. Bonds are more attractive to me. So I'm not going to invest in stocks, or if I have stocks, I'll sell them and I'll actually buy bonds. So this is why it has a negative effect on the stock market. It doesn't mean if the dollar's up and bond yields are up, the stock market is definitely going to decline, but it has this general traditional influence. Is there an advisable, I'm guessing you were trying to say, is it advisable to invest in equities as a beginner? We cannot give advice, ladies and gentlemen. What I will say is, whatever asset it is that you're going to trade, to stick to it. And most important thing, the lowest spreads possible, and that you're sticking to that asset. I've got another question, very similar again. Unfortunately, I cannot give advice. So what is the best asset to trade? What's the best time to trade? What's the best currency pair to trade? Again, it's completely down to you. What I do is I provide the educational material, and then it's down to you how to, what to choose to invest. What I will say is, again, Euro USD has the lowest spread. So of course, if you're looking for the asset which is the cheapest, which is one of the most important things for scalpers, then of course you're going to be looking at the Euro USD, the pound against Japanese yen, and so on and so forth. Can you provide signals for beginners given your vast experience? No, unfortunately we cannot. I cannot, because I don't give investment advice, but you will not need the signal from me once we finish today's webinar, because you'll see the strategy, you'll add the indicators to your MT5. You can get a recording of this strategy. You don't have to know everything off by heart, and you can obtain signals and analysis and entries and exits and so on and so forth by yourself, which is even better than having to rely on me. So what can assist new traders? Number one, we're going to go through this very quickly because I want to start looking at the strategy on the next slide, because we're very close to looking at the strategy now. So what can assist new traders? We said, number one, trade one asset. Finished. Next bullet point. The performance of an asset changes from one session to another. Therefore, beginners may benefit from trading only in one session. So I've got an example of this actually, which is why I said in the previous slide, not only to trade one asset, but only in one session, because it acts differently in a specific session. So for example, here you can see we're looking at the NASDAQ. You can see the market opens and we see it declining. A new session opens, a European session. What happens? The price starts to increase with a certain level of volatility. It's completely different. Then the US session opens. What happens then? A completely different type of price movement. More volatility, much more volatility. So what we can actually see here is after each session, the volatility changes, sometimes the direction changes. So it's important to be looking at one session, one asset. Of course, if you want to be looking at something completely different, many sessions, many assets, again, you have full control over your investment. It is also important to review the day's bias once the session opens. Again, look at before the market opens, the day's bias. The session opens and you start to trade, doesn't mean you forget that the bias may change. The bias may change. So again, keep on looking at that again and again. Another thing which is very important, especially for stock traders, for example, people trading in NASDAQ, review previous markets if applicable. Well, I say if applicable because of course it's not going to be applicable to currencies or commodities, but with the NASDAQ, S&P 500, Dow Jones, DAX, so on and so forth, it is definitely applicable. So for example, if the session is about to open, what you can also do, instead of, in addition to looking at the dollar, bonds, and the components, look at other markets which have already been trading for some hours and are close to the end. So very simply, if you're trading a US session, look at how the DAX in Europe has performed. Look at how the CAC in Europe has performed. Because if European markets are decreasing in value and Asian markets are decreasing in value, and these are already about to end because of the time difference, if all of these stocks are decreasing in value, it's indicating that globally the investor sentiment is very poor. So it either means people are switching to the US market, and that's why it's declining because they want to expose themselves to that market, or investor sentiment is very poor and it will also be for the US session. So again, there's a possibility, another bias that the price will decline once the session opens in US. Strict exit points, we've said this again, keep trade journals to review your trades. What do I mean by trade journals? Note all of your trades, when you're entering, when you're exiting, your success rate, your reward to risk ratio, and revisit it. This trade that I closed, did I enter at the right point? If so, okay, perfect. Did I exit at the right point? Could I have held on to that trade longer? Because if I'm finding a scenario where I could have held onto the trades for longer, I can take that into consideration. If it's a scenario that I'm opening trades and keeping them open for too long, and because of that, some of those trades move into a minus, then it means I need to be closing the trades earlier. So again, I've got some questions. Yes, the recording will be available to attendees. You can also speak to the support team. They can provide you with that. How can stock margins and stock margin losses and profits calculated? I'm guessing you mean be calculated. Can we look at this at the end? It depends what you mean by how can it be calculated. So it depends, please clarify, and of course I will look at it. If you're referring to what the calculation is, the best thing to do, I can tell you the calculation, but the best thing to do is go to the support team from the live chat and ask them for the calculation, and they'll provide you actually with a PDF that you can save on your phone, you can save on the computer, and you can always have access to it rather than me telling you it. You have to make a note of it, if that's what you're referring to. If not, clarifying, we can look at it. Will the slides be available? Yes, of course. Where can I learn more about keeping a journal? We will have a webinar later this month. You can find it on our webinars page. Register for it, and it'll be a whole webinar looking at journals. So, sorry, I'm rushing through the questions because I want to start looking at the strategy, because now we're looking at the strategy. So what indications am I going to be using as part of the strategy? People want to take a photo or screenshot of this just so you have access to it until we send you the PDF. Of course. So what indications will we be using? The first one, we're using three time frames. The first two time frames are medium-term time frames. The second time frame is an ultra short term time frame. So it will either be a 1 minute or 2 minutes. So on the first medium term time frames, which are here, we're actually going to be looking at two indications. The 75 bar EMA, a relative strength index with a 20 bar period. Now, some of these may need to be altered depending on the characteristic of the asset. If you need some assistance of this, of course, we'll look at it. The second set of time frames that we will look at, we will use a Bollinger Band, we will use moving averages, two moving averages to be specific, an 8-bar EMA, and also a 16-bar EMA. So let's move on to our next slide. So scalping strategy, step number one, asset number one. This is going to start to get really, really interesting, ladies and gentlemen. So this is gold against the US dollar. This is looking at the price movement earlier this month, more specifically last week, but we're also going to be looking at movements from today as well as the past week. So here we've got two time frames. We've got a 2-hour time frame that you only have access to on the MT5, not the MT4. And here we've got a 30-minute time frame. We can see our 75-bar EMA here and our RSI here, ladies and gentlemen. Now, how is this helping us? It helps us in two ways. This here, ladies and gentlemen, is known not as a trend line. It's not a trend line, slightly different. It is known as a price sentiment line. So is the sentiment bullish? Is the sentiment bearish? So is a strong or weak sentiment for the price? So if the price is below, we have weak sentiment. So when the price is below, it means most of the price movement is downwards. So think of it as this way. If you've got a dice and 5 sides are the number 1 and 1 side is the number 2, and you roll the dice, you're going to say most likely it's going to land on the number 1 because most of the price movement is in that direction. The same thing applies to here. If most of the price movement is in one direction and scalping is a trend-based methodology, then of course you're going to be looking at that direction and not looking at the smaller, less frequent price movement, which is in the opposite direction. Keep in mind, this is based on this methodology. Some people may be looking at mean reversion, in which case this isn't the scenario. Then we've got our RSI here, the relative strength index. So here we've got 4 zones. We've got above 75, so the price is overbought. We're not buying in that area. We've got below 25, oversold, so we're not selling in that area according to the indication, that is, not me, but the indication. Then we've got the neutral here. So if it's between 50 and 75, it's indicating buyers have control. If it's between 50 and 25, it indicates sellers have control. So we want to marry these two up, and as well as these two time frames, same indications. If the price is below, like we can see here, ladies and gentlemen, and also the RSI is below, like we can see here, but it's not oversold, then we're looking at starting to look at opportunity that the price is going to decline. We can see that between it declining here, below for the first time, and all the way out to today, most of the price movement is downwards. Doesn't mean all of the price movement is downwards. It doesn't mean you instantly sell because it's below the line. It's not art. Trading doesn't work in that way. But we can see here, it very clearly is giving us the direction of the market in the medium term, which I said, like I said, it's not necessarily as important. And then we switch over to a smaller time frame. We here got a 30-minute time frame. So we also want the price to be below. So we of course need to determine what area of the market is the appropriate area for us to be trading. And keep in mind, we also only will be trading in the lower time frames if these are all marrying up. They're looking at the same direction. So this area is ideally where we want to be trading here, because the price is declining, the candlesticks are red, and we're below the RSI, and we're below the moving averages as well. The next area we want to potentially consider a decline is here. We could have even potentially considered the decline here as well. Why? Because we have some red candlesticks. We've got a lot of red candlesticks here, and in both regions, we're below the neutral and we're below the sentiment line. The only area we, of course, are not going to be considering is this area here, where it dips above very slightly for a very short period of time. Then we switch to a smaller time frame. What area can we potentially scalp? This area, for example, and this area here. Now, what I'm going to do is I could have very simply have said, we're going to look at this area here, in which case it's going to be very easy to trade, very super easy to trade. Why? Because the market is moving in one direction. So it's easier to trade using this strategy. When I say easy, I don't say, not saying trading is easy, but the strategy is easy to follow because it's just a very straight line downwards. I'm not going to concentrate on that. I'm going to concentrate at a different time where there was more volatility, but we still are ticking both boxes. So we want to be below on the 2 hour. We want to be below the 75 by EMA, below the 50. We switch over to a 30-minute time frame. We again want to be below, and we again want to be below the neutral. Now, if we've ticked all of these boxes, then we can proceed onto a smaller time frame. So this is a 1 minute time frame, ladies and gentlemen. And this, ladies and gentlemen, you will see is not during it, because you can see I've kept the times there, ladies and gentlemen. You can see the time of this period here between 6:30 all the way up to 9:30. You can see that if we go back, I'm not looking at this very easy area to trade. I'm actually looking at this area to trade, which is a lot harder, and the market is moving against me. So you can see, because I don't want to be using the easiest areas to show you an example, I want to show you the most difficult areas, so that when it's the easiest areas, you can very simply and know how to trade the market. So what do we need after that? We switched over to a 1 minute time frame. So we've got two moving averages. We've got a moving average here, which is the red, which is a 16 bar simple moving average. Then we've got the yellow here, which is an 8 bar exponential moving average. Then we've got our Bollinger Band, which is this cloud here, which is 3 blue lines. This is what we're going to be using to be determining when to enter and also when to exit as well. But because we're scalping, we're not ever looking to earn per trade more than 0.10%. Why? Because we don't want to be in the market for too long. We want to enter, earn a very quick profit. Even 0.10% for a scalper is a very large profit, because we're opening trades again and again and again. So like, this is why I say it's a very large profit, because we're only looking to be in the market for a short period of time. So 0.10% will be the cutoff point. So even if the market keeps moving in one direction, I cut it off at that point. I cash in my profits. So how do we determine now how to trade? And it's very, very simple. We want the yellow to cross below the red. This is where we get an indication that the price is going to decline, potentially going to decline. So it's at the crossover we enter the sell. It's not 30 minutes after the crossover. It's not 5 minutes after the crossover. It needs to be at the crossover. So here, for example, ladies and gentlemen, you can see it crosses over downwards. So this, at this red line, is where we would trade. Now, where do we exit? Now, it depends if it moves in our favor or if it moves against us. Now, if, let's say, it starts to move downwards like this, but then moves against us, as soon as it hits this blue line, we exit. So as soon as we hit the upper side of the Bollinger Band, we exit, regardless of if we're in a profit, if we're at break even or small loss, we exit. Whereas, how do we know when to exit when we're in a profit, because we are about to see most of the time it is a scenario where we're in a profit. And it's very simple. There's two ways. First way, we've already mentioned 0.10% automatically straight away exit. Point number two, if the candlestick crosses below the Bollinger Band, so if we look at this area of the market here, if it crosses below the Bollinger Band for 3 candlestick, on the fourth candlestick, if it's still below, you exit. So keep that in mind. It's not as soon as it crosses below the Bollinger Band, you exit. No. As soon as it crosses, if 3 candlesticks after it's below, when the fourth candlestick opens, you exit. So based on that, ladies and gentlemen, this first line here, because I've got red lines where we've got indications, you can see you would have opened here and you would have closed the trade, ladies and gentlemen, here. And that is a profit of 0.09%. Next trade is here. Here you can see we get a downward crossover again. With this though, ladies and gentlemen, we're never in a scenario until we get to this area of the market all the way down here. We're never in a scenario where 3 candlesticks are below the Bollinger Band and then the fourth opens, because 3 is not enough. It needs to be 4. It's when the fourth opens, if it's below, then we close. So here it doesn't happen until all the way down to here, ladies and gentlemen, whereas we actually close up here because we've reached 0.10%. So here we've earned 0.10%, ladies and gentlemen. So far, 2 trades, 0.19% in a very short period of time. Next indication, we've got a downward crossover here. But you can see we have 1, 2, 3 candlesticks below, but then the fourth isn't below, so we cannot exit it. And what actually happens, the price starts to move against us and we close the trade here because it hits the upside of the Bollinger Band. Now this, like you can see here, is at the exact point that we opened the trade. So here we're actually at 0. We're at break even, neither loss or profit. And then the next slide, ladies and gentlemen, the next asset, next indication, it crosses downwards here. We've got 1, 2, 3 below, and the fourth also opens below, so we close the trade. Here we're on a profit of 0.04. So just in this time period here, ladies and gentlemen, we're at 0.23% in a profit. 3 trades in a profit, 1 at a break even. Break even, ladies and gentlemen, is not an issue, and a losing trade is not an issue, as long as your winning trades is more and more frequent. Next asset, here we're looking at the USA 100, also known as the NASDAQ. What are the names of these trend lines? Depends which one you're referring to. So let's go back to this slide here, actually. So the lines where it's a single line, they're known as moving averages. The one which is free in the color of blue is actually a Bollinger Band. If you need assistance with this, you can go to YouTube and type in how to enter a Bollinger Band, and it will confirm this for you. So now let's look at the NASDAQ. So again, we're looking at 2-hour time frame, 30-minute time frame, same indications. This time though, we're looking at a potential buy. Why? Because the price is above the sentiment line and it's above the 50 and below 75 on the oscillator. Same thing here as well, ladies and gentlemen. We're above the sentiment line and we're also above the 50 on the RSI. We though would avoid buying in this area of the market here because that's where we actually become overbought. But we can see both, we've ticked the boxes that we needed to tick, that we can switch on to a smaller time frame to look at where potentially we can buy. So we want this time upward crossovers, not downward crossovers, because we're here above the sentiment line. So we're looking at opportunities to potentially buy. So here, ladies and gentlemen, we want upward crossovers. First one, ladies and gentlemen, is here. It crosses the Bollinger Band actually here, but then it doesn't cross again, whereas it crosses 1, 2, 3, happy days. And then on the 4th, we're above, so we close. Here, we're up 0.15%. This is just to show you it went up 0.15%. We wouldn't be holding on to 0.50%. We would close at 0.10. Then the next asset here, so it crosses over upwards. Then it crosses the Bollinger Band here, but not on 4 occasions. Then the price actually declines and it touches the Bollinger Band lower side here. So we close the trade there. So here we're actually in a slight profit of 0.3%, because even though it dropped and hit the lower side of the Bollinger Band, at first it increased in value. So you can see still slightly higher. But to be honest, 0.3%, if you're being charged 0.2%, for example, it's not much of a profit. But of course, it's adding up, because keep in mind, you're active, you're opening a lot of trades. Then the next asset crosses over, next indication crosses over upwards. This time there's a very big indication. So we, of course, 0.10. So here we're looking at, in this period of time, 0.23. Let's look at another asset, this time so Euro USD. This time though, ladies and gentlemen, I'm slightly looking at a lower take profit, because more leverage is available here, and also there's less volatility. And in addition to this, of course, because of this, I'm changing the time frame on the second slide to actually a 2-minute rather than a 1 minute. So here, Euro USD, this time we've got a 2-hour here and a 30 minutes, same as before. Here we're below, but then starting to struggle and hit on occasions the upper side. So in this area, we need to be slightly cautious here. But other than that, all in this side here, very clear indications that the euro will decline. In this last slide here as well, if we switch to a 30-minute, you can really see what I'm referring to. No clear direction. It's just mean reversion, up, correction, down, correction, and so on and so forth. But of course, when the price is below, like here, we look at opportunity to speculate a decline. When the price is above, like here, opportunity to speculate a price increase. But we need to be cautious that it may end quickly. Keep that in mind, because of course, we're not looking at a trending market, but a sideways moving market. So this time we're looking at downward price movements, because here we're looking at this area of the market here. This area here, ladies and gentlemen. So here, ladies and gentlemen, we can see the first indication is here on the top left, because the yellow crosses the red downwards. So that is indication the price will decline. Here, it would have earned 0.8%. Same thing here, ladies and gentlemen. We've got 0.3%. This trade here, this actual slide, there's no losing trades or break-even trades at all. The only trade which was a negative trade, would have had a slight loss, is this here. We saw a downward crossover, but then it went straight back up and it hit the Bollinger Band. So you would have exited that straight away. But then we got another crossover downwards, so you could have, of course, re-entered. So ladies and gentlemen, that brings us to the end of the webinar on strategy. So let's quickly look at the questions. Is it 0.10% of your account size? It's completely down to you. But what I will say is scalping is known to be using very small size trades. This is a very strong characteristic of scalping. What would be an appropriate loss percentage to maintain a good risk management practices? If you're referring to your stop loss, is the Bollinger Band, ladies and gentlemen, is the part of the Bollinger Band. So if you're looking to, if you're here in this area and you're looking to speculate downwards, as soon as it hits the upper side of the Bollinger Band, if the market moves against you, this is where you're exiting. So if you're referring to percentage in terms of the stop loss and exiting, it's not referring to percentages. We're looking at the Bollinger Band. If you're referring to your account in general, there is no correct reward to risk ratio. This is what is known by reward to risk ratio. depends on your success rate. For example, somebody with a high success rate can have a very negative reward to risk ratio. But if somebody has a very poor success rate, they're not able to determine how the market is going to perform, then they need a very high reward to risk ratio. So there's no correct answer. It depends on you personally and your success rate. The important thing is that mathematics makes sense between your success rate and the reward to risk ratio. So for example, if I'm opening 10 trades a week, how many of those trades tend to be in a profit? This is your success rate. Based on that, let's say 7 out of the 10 trades, what reward to risk ratio do I need to still be profitable, even though I've got 3 losing trades every single week? So this is what you use to determine it. The setting, I've got an individual who's asking about the settings on the Bollinger Band. I will share my screen in a moment. Well, actually, I'll tell you, it's 20. So those are the settings for the Bollinger Band. Please recommend reading material on risk management. Best thing to do is to sign up to the webinar on risk management. I don't have a specific book necessarily for you to read, which is purely based on risk management, but following webinars can be very helpful. What do the percentages below represent? These are the price after the indication. This is how much was earned based on the indication. So for example, I opened, bear with me. If let's look at another example actually. Let's look at here. Here we're looking at upward price movement. Here we're looking at the USA 100. So for example, as I opened a buy, for example here, a lot of upward price movement, I closed at 0.10. Here I closed at 0.3 based on the indication. We're looking and showing you the outcome. What does the yellow line stand for? The yellow line is the 8-bar exponential moving average. So any other questions, ladies and gentlemen, feel free to ask now. Otherwise, we'll end today's session. I'll give people a couple of minutes. If anybody has any questions, feel free to ask. I've got a lot of messages. Great webinar. Thank you for this webinar. Very helpful. It's my pleasure, ladies and gentlemen. Really my pleasure. Hopefully it's educational and helpful for you all. How can I get a PDF with calculations? Speak to the support team through the live chat. That's the best and easiest way. If you need help, generally speaking, with calculators, calculations, because we also do offer calculators. All right, I can't see any more question. Best scalping time frame. I cannot advise which is the best, but today's strategy we looked at 3. We looked at 2 hour, 30 minutes, and a 1 minute. Of course, the 1 minute though was used in terms of entry and exit. So I can't see any more questions. Let's end today's webinar. Trade safe, trade responsibly, and hopefully we will see you very soon on one of our webinars. My next webinar is next week. Feel free to register. We also have 2 more webinars this week. Trade safe, trade responsibly. Enjoy the rest of your evening, and hopefully we'll see you very soon on one of our webinars. In the meantime, goodbye.